Good morning from cloudy and at 27 degrees, relatively balmy Chicago. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money bi-weekly podcast. Today is Super Bowl Sunday, February 8th, 2026. In today's podcast, our focus is on the benchmark S&P 500, which, despite Friday's enormous 134.2% rally, is still just 20 S&P index points, or about 0.3% higher than its October 29th peak. The market has essentially been moving sideways for the past 3 months. Meanwhile, though, there is a lot of kind of under the hood stuff going on, a lot of indications of internal market weakness. Offensive technology stocks are underperforming the S&P 500. The defensive Dow is outperforming the S&P 500. Foreign equities are outperforming the U.S. market. Dividend stocks are outperforming growth. And the equal weight S&P 500 is outperforming the market cap weighted version of the S&P. Meanwhile, the cyclical industrial, energy, and material sectors are all outperforming, which are global growth sensitive and typically inflationary. We have been long and overweight a number of commodity markets in that space, as well as small cap and value stocks. And also, we've been overweight emerging markets. That's been working out quite well. We're going to look at a bunch of these in a little bit more detail during today's podcast. But before we do, let me just take a minute to give you some information about us. Asbury Research is a registered investment advisor. We've been providing investment research to both individuals and professional money managers since 2005, which makes this our 21st year in business. Most recently, we have created 4 model portfolios using our own in-house models like the correction protection model or like the CEF model as building blocks for managed accounts. These portfolios have all been through rigorous 8-year quantitative backtests and have been trading in real time now for about the past 18 months by both individual investors and professional money managers. They're designed to produce S&P-like performance, but with significantly lower drawdowns and lower volatility, or to produce relative outperformance versus the U.S. broad market, but with similar risk to the S&P 500. For those investors that are interested in research, we have 2 levels of research service available. We have our Asbury Premium, which is what we launched Asbury Research on in 2005. It's for more serious investors. We sell the research to both individuals and also other money managers, other professional investors, and they include the latest updates on all of our models and also some one-on-one time with us via Zoom so you can integrate these ideas and models into your own portfolio. We also, not too long ago, I should say, we have started an entry-level Substack newsletter. Here it is. And it's entry level. It's for people that may have seen us through our YouTube videos or maybe saw me interviewed on IBD or Schwab Network or somewhere, like our approach, are interested in what we're doing, but they're more of a novice and they just kind of want to learn a little bit more about us, see some of our research, and see if it's something that's going to work for them. It's $25 a month. Again, it doesn't include all of our trading models, but offers 3 different special reports that we use to show you what's going on in sector rotation, what are the key charts to watch for the week, and also a quantitative screen that shows you where the opportunities lie in global assets. Again, there's a free version here. So if you like our videos, you like our approach to markets, I strongly suggest that you sign up for the free version. It's kind of a no-brainer. You get to see more of our stuff for free. Here you could see I did an interview yesterday with Jim Poplava of the Financial Sense News Hour, which you're probably familiar with. They interview every top person in our business and have been doing it probably for more than a decade. So enough said there. Let's get started by looking at the markets. And we're going to begin with our Asbury 6. Most people that know us are familiar with the Asbury 6. Whenever I get interviewed, it's usually a topic of discussion because what the Asbury 6 is, as I go to it here, we're in the research center. So this is the paywall. We're inside the paywall. What the Asbury 6 is, it's a data-driven gauge of the U.S. stock market's real internal health according to 6 diverse metrics, which we selected and kind of used as kind of a team via quantitative backtesting. We looked at, I don't know, dozens of different tactical indicators that I've used throughout my own career, and we found 6 that work really well together in terms if 1 or 2 of them are not giving you a good signal for on a particular day, the other 4 will pick it up. They work very well together in kind of giving us a daily under the hood assessment of what the internal health of the market is, rather than chasing the tail of the S&P 500 as it's up 100 points today and down 100 points tomorrow. Think of it as a daily EKG for the stock market. Here it is. So through the end of last week, we are 4 green and 2 red. And the 6 are here. They're the rate of change in the S&P, relative performance between stocks and bonds, asset flows, volatility, trading volume, and market breadth. The green ones indicate a positive reading, the red ones indicate a negative reading, and the numbers inside the cells indicate the dates that these turned. So you can see, generally speaking, a lot of these metrics turned because of the huge update that we had on Friday. A6 averages about 10 round turns a year based on hypothetical backtesting since 2017 and has basically stayed right on top of the S&P 500, but with a 60% lower max drawdown. Max drawdown in the S&P during this period was 34%. Following this, and admittedly, it's very busy. 10 times a year is a lot of trading for some folks. But the max drawdown here has only been 16%. Again, currently 4 green, which is tactically positive for the market. As long as the A6 remains 4 or more green, the stock market is likely to continue steady to higher. If it shifts to 4 red, it indicates that whatever happened on Friday, the market is having second thoughts about it, and it may be rolling into a correction. The next thing we're going to look at as we go back to the research center is we're going to look at our SEAF model. SEAF is an acronym. It stands for Sector ETF Asset Flows. And we're going to go straight to the graphic and have a look at it. SEAF is currently overweight XLE and XLI. You could see those are currently the 2 top rated. The SEAF model is always fully invested in the market. Whether the market's up, down, or sideways, it's always in the market. It was created to be a dynamic, market-driven, or data-driven, I should say, alternative to the traditional buy and hold portion of a portfolio. Most money managers, and I think generally most investors, don't come all the way out of the market. They always keep something in the market. It might be a third, it might be a half. So they might be tactical on a part of their portfolio, and another part of it might stay in something vanilla like the S&P 1500 or something to that effect. This was meant to replace that. What we did was we created an algorithm that determines where the money is going within the 11 sector spiders and how fast. And right now, again, the top 2 are the XLE and the XLI. Let's have a look at those. So we're going to just jump over. Here's XLE. On top, we have XLE. This is daily, and this goes back to the beginning of the fall. Down here is the relative strength of XLE, which is the energy sector spider, versus SPY, which is the S&P 500 ETF. Right here, these orange arrows is where it became a buyer, and overweight according to the SEAF model. So you can see through Friday, so far up 12% outright and up 11% versus the S&P, which particularly significant here as we back away from the chart a little bit. See, it's a pretty good breakout. Over the past couple of weeks, we've broken out of the highs that we made in April of 2024. The other overweight, according to SEAF, is XLI. That's the industrials. And that overweight was triggered right here, which was almost a week ago. It was this past Monday, Feb 2nd. Since then, it has risen by 3.44%, and it's outperformed the S&P 500 by 4.1%, let's call it. So let's go back to where we were and looking at the SEAF. So since inception in mid-2018, SEAF has significantly outperformed the S&P 500 on an annualized basis, but with about a 4 to 5% lower maximum drawdown. Why are drawdowns so important, and why do we talk about them? Well, one of them probably has to do with my age. I'm in my 60s. I don't trade or I don't invest like I did when I was in my 30s, down at the Chicago Mercantile Exchange, or even into my 40s. The game changes once you get into your 60s. When you're in your 30s and 40s, you're dollar cost averaging. If the market goes down, that's fantastic because you get to build that dollar cost average and you get to get some better prices. You can, buy at lower prices, and as it averages out over the decades, you're better off. Once you're in your 60s, and maybe even in your late 50s, the game changes. It's like being in the fourth quarter of a football game. In the first half, you throw the ball downfield, you can handle the ball in the backfield, you can take some chances because you have time on your side. Once you get into the fourth quarter and you have a lead, and I think most people that are going to use our service probably have a lead of some kind. They've been investing for a while. They have some money. Now you don't want to make a mistake because the clock becomes a factor. So take, for example, drawdowns versus the recovery. In 2020, during COVID, it was basically February through April, the S&P drew down 30%, 34% rather. Here you could see a 30% drawdown here. It requires a 43% move back the other way in order to get to where you were before. So that's why this makes a difference. Our CPM model, which we didn't talk about today, but it's a part of our premium service. You can see this is going back to 2018. In 2018, the S&P drew down 19.8%. The CPM model, our model, only drew down 15.10. Here's COVID. COVID, the S&P drew down 33.9. CPM only drew down 9%. Last year, the S&P had a max drawdown of 18.9. Our CPM only drew down 9.3. The A6 has similar characteristics in terms of keeping you from taking a big hit. So next thing we're going to look at here as we go back to the website is we've got a report called Keys to This Week. It's once a week. A similar report is also available in our Substack. That's the Substack that you have to pay for. It's $25 a month, but it does have this kind of information in it. I wanted to go through 3 charts from here. We don't have time to go through all of them, but I want to go through 3 charts that I think are particularly important to pay attention to. The first one is chart 5. So I'm scrolling down to my chart 5 here. And this shows the relative performance of SPY, which is the S&P ETF, versus AGG, which is the aggregate bond index ETF. And what it shows that here's the relative performance line in blue. The green line is the 63-day moving average. What it shows that basically since May the 8th, SPY has been outperforming ag. Stocks have been outperforming bonds. When that happens, that's typically during a healthy bull market. Look what happened here in October 10th and 16th, Nov 20, D17, and Jan 16th. All four of those were a test of that 63-day moving average. All four of them held, and they were all really good bottoms to buy in the S&P 500, basically buying the dip. Well, the same thing happened Friday, but even after the close Friday, we're still right here. We're testing that 63-day moving average. So either Friday was a bottom, a tactical bottom is what we'd call it. But if this relative performance relationship flips next week and starts to turn down underneath that 63-day moving average, that will indicate, at least to us, that the market's starting to peak. So it's a big deal to us, and I wanted to share it with you today. Next, we're going to scroll quickly down to number 8. And what this is showing is that the relative performance of equal weight S&P 500 is outperforming the S&P 500. You can see that started on December the 11th, and it's outperforming it on a quarterly basis, which is why the 63 days business quarter. Typically, the equal weight S&P 500 will underperform when the market's going higher, as it did here since April 24th. I'm pointing to it. When it starts outperforming, it usually means the market's changing its character. It's starting to weaken. And you could see that really since October, the market's been flat. A lot of noise, a lot of sideways, but it's basically been flat. As long as this continues to outperform, that equal weight, that's a red flag for me, and I'm going to be kind of on my toes looking for other indications that the market may be weakening internally. Number 9, SPDW is global equities in developed markets minus the US. And you can see that they've been, after going sideways since October, kind of equal with the S&P 500. In the early part of January 2nd or 3rd, they broke out. They started to outperform. Global markets, I think of the 25 global markets that we track in our US versus the world model, 22 of them, 21 of them, 22 of them this week are outperforming SPY. Generally speaking, and again, there's no absolutes in the financial markets, but generally speaking, when you see the rest of the world outperforming the US, that usually happens when the uptrend in the US is getting tired or the market's starting to roll over. So these are not sell signals. These are environmental indicators that are telling me that even though we had this great rally on Friday and everybody's happy, there's some stuff, and there's more than this. There's a lot more indicators like this, relationships like this, that are giving the same message, but I wanted you to see these today. The next thing we're going to look at is our ETF trade ideas, which is another component of the premium research product. So basically what we do is we scan 6,600 ETFs every morning, early in the morning, 5 in the morning, and we scan them for our own criteria that have to do with trend, relative performance, and asset flows. It takes that 6,600 and it culls out a small subset of that. Sometimes it's 10, sometimes it's 20, but we get a list every morning. Then I go through each of those one by one, and I try to find, through my experience of doing this for 40 years, the ones that show the best risk reward opportunities. Either they just broke a trend line, or they're on support, or there's some other technical factor there that gives me a risk reward advantage. I pull those out. And those are the ones that we buy. So right now we have 3 of these. Let's look at 2 of them. EEM, emerging markets, and we put the trade on 127. So let me go over here and pull it up, EEM. So here's EEM, 127. So we bought this here and we're about even on the trade, maybe down a shade. It's been a relative performer versus the S&P 500, but I like the fact that we had a big breakout here. Let's look at this without the relative performance part so we can see it closer. You can see we broke to a brand new high. We broke out to a brand new high. The old high was from February of 21. So again, it's holding its own here, but it's got some promise because we've got a pretty important breakout that took place. The other one, as we go back here, is XES. So we'll go back and take a look at XES. XES is a part of the energy space, and we put that out as an idea to our subscribers right here on Jan the 14th. You can see since then, it's risen by 14%, and it has outperformed the S&P down here below by 14%. What I like about this is a pretty good breakout here. Look at all these all this activity up here around the high that we made in September of 2023 at 100.81. This is a pretty new breakout. So that's how this works. And as we go back, we've been doing this for almost 3 years. In 34 months, we have had 120 trades. It averages about 1 trade a week. Our Sharpe ratio on this is 1.4%. That's an incredibly good Sharpe ratio to hold over a 3-year period. Look at our maximum drawdown is only 3.7%, minuscule drawdown here. Our Sortino ratio over 2 is outstanding. 54% of these trades have made money. The average winning trade has been 5.5% profitable. Average trade length of the winning trades is about 20 trading days, just shy of a business month. Average losing trade is only 2.4%, and only in those trades for 8 business days, which is about a week and a half on the calendar. So more winners than losers. Winners more than twice as large as our losers on a percentage basis. That's the recipe to have a good system, again, with a 3-year look back. So this is kind of how we look at things. There is a very, very little bit of subjective input. Everything is really driven by data. In our world, that's the way. I sleep better at night. I make more money by turning this over to quantitative strategic trading rather than trying to guess or forecast, which to me is pretty much a synonym to each other. So last thing, Sort Report. Sort Report is the $25 a month service, entry level if you're just starting and you like our approach. Our Sort Report, which we're going to look at, this is one of 3 different components in our Substack. So what this does, Sort Report tells us which parts of the global market have positive trends, are outperforming their benchmarks, and they have positive asset flows, which means that new money is coming in to push the price of that ETF higher. Again, very low cost way to make better investment decisions based on data and not on opinion or economic forecast. Remember, forecasting is a euphemism for guessing. We just believe in following the money and following the data. So what this is showing is there's a lot of opportunity out here. We have emerging markets, which I had mentioned just a few minutes ago. We have global equities, ex-US, gold, commodities, crude oil, US interest rates, and small cap are all showing opportunity as far as trend, relative performance, and also asset flows or money flows. That means this is kind of a sifter. So this tells you any of these particular headings. You could look underneath. This is where you look for value. For gold, it could be gold miners, For the commodities, it could be energy, it could be lumber, it could be anything that has to do with that space. But this is updated twice a week, and this tells you what is clicking on all cylinders, so to speak. These are where you've got these three, which we think are really important attributes to have. We don't buy anything unless the trend is positive, it's outperforming its peers, and we've got asset flows that are going in to help support the move higher. So this, with two other components, is part of the Substack service. So with that, that's going to wrap up our latest Asbury Research Following the Money for today. We looked at a lot of stuff today, very interesting times. I'm going to be interviewed on the Schwab Network next Wednesday, 2/11, Feb the 11th, at about 9:15 in the morning Chicago time. Something I do every month. If you like what we're doing, you may want to tune in and see what we have to say. It may be a splashy early part of the week after Friday's crazy day. Our next Follow the Money podcast is tentatively scheduled for Sunday, February 22nd. I hope to see you then. In the meantime, if you have any questions about anything that you saw here or want more info on our research subscriptions or interested in a managed account, the best way to do that is to contact us right here via the contact tab at asburyresearch.com. I will see you in 2 weeks. Enjoy the Super Bowl this evening and make sure you like and subscribe. See you in 2 weeks.